Welcome back to the deep dive. You know, if you follow economic news, it feels like whiplash sometimes, doesn't it? One minute, inflation's supposedly dead. The next, it's back. But what if there's something deeper going on? Something actually powered by, well, power. Today, we're diving into the latest special service newsletter from the Macro Butler. It's called Flation. Now, this newsletter, it definitely has a specific viewpoint, sometimes pretty provocative. Our job here isn't to agree or disagree with their politics, but just to unpack their analysis for you. We want to explore these links they draw between energy, inflation, and the economy, helping you see maybe the underlying dynamics that affect, well, your daily life. By the end, hopefully you'll get some aha moments about why your power bill might be climbing and what that connects to. So let's start with their take on the latest inflation numbers. The August CPI, they said it strutted onto the stage with a plus 0.4% month-over-month gain. That's a bit hotter than July's plus 0.3%.
Yeah, and year on year, that landed at plus 2.9%. The newsletter really flags energy, mostly oil, as playing the diva role in that number.
And goods inflation.
Well, they say goods came roaring back, the biggest yearly jump since May 2023. Food prices, too, the biggest surge since October 23.
Okay, but what about core services? I heard that slowed down a bit.
Just a tiny bit. The newsletter puts it like core services only took a coffee break.
Yeah.
So yeah, slight easing there. But the core CPI, right, stripping out food and energy, that landed pretty much where expected, plus 0.3% month over month, holding at 3.1% year on year. What the Macro Butler finds really telling, though, is that even with core services easing slightly, and remember, that's like 76% of the inflation measure core goods stayed inflationary for the fifth straight month.
Straight month.
And maybe the bigger point they make, we're now on month 63 of uninterrupted core CPI gains. 63 months.
Wow.
Yeah. So they argue this isn't just some statistical noise. It's a trend that, affects everyone, not just economists.
Month 63. That really puts it in perspective. So clearly the newsletter is pushing back hard against this inflation is dead idea. What specifics are they pointing to?
They use some pretty colorful language, like owner's equivalent rent, OER. They call it the undead zombie of CPI.
Okay.
It came in at plus 4.0% year on year. That's barely down from July's plus 4.1%. So they say claiming victory on that is like bragging your fever's only 102 instead of 103. It's still high.
Right. Context matters.
And then there's supercore CPI, that's core services minus housing, something the Fed supposedly watches closely. That held firm at 3.21% year on year. Didn't accelerate, but didn't drop either. So their conclusion, and paraphrasing their strong wording here, is basically inflation's dead only if you ignore rent, goods, food, reality, and maybe take a big dose of hopium.
So they're saying the optimism is misplaced based on cherry-picking the data. Okay, but despite all that, Wall Street seemed pretty happy. The newsletter says they threw itself a victory party after the CPI print. Dow, S&P, NASDAQ hitting records. Traders are still betting on rate cuts soon, like September maybe. How does the newsletter explain that gap between their view and the market reaction?
It is a disconnect, isn't it? The newsletter kind of suggests that for the market, reality is just an optional extra sometimes. Right. They point out the dollar actually weakened more because of some soft U.S. labor data and a more hawkish ECB, not really the CPI itself. Gold didn't really react.
Interesting.
And the 10-year Treasury yield still stuck near 4.0%. The Macro Butler thinks Wall Street is just, clinging to the fairy tale that bonds will stay safe, even with what they call potential Trump stagflation looming.
Trump stagflation. Okay, that's a term we need to unpack. What's the newsletter's idea behind that?
Well, they're painting a picture of potential future where certain policies, maybe trade tensions, tariffs, that kind of thing, could lead to both rising prices and slowing economic growth. Stagflation. They suggest the brief deflation scare earlier this year was a mirage, and that this Trump-reflation express, as they put it, is already underway, tariff tolls included.
So protectionism leading to higher costs, basically.
Yeah, that seems to be the core idea, that these policies, regardless of intent, will push up prices even if the economy itself isn't booming.
And they're critical of, say, the Fed aiming for a 2% target in that kind of environment.
Oh, highly critical. The newsletter uses some pretty pointed language about officials celebrating an imaginary 2% target while inflation's still running over 3%. They sort of mock the idea, saying it's like success means shrinking margins and taxing consumers with a grin.
Yeah.
Their math suggests hitting 2% would require CPI to actually go negative each month, which seems, well, unlikely given global tensions and potential tariffs. They think we're more likely heading towards 3.5% or even higher by year-end if current monthly trends continue.
Okay, so if inflation's still bubbling under the surface and businesses face rising costs, maybe from tariffs or energy, Who pays? Where does the buck stop?
According to the Macro Butler, the buck stops with the consumer. Their message to investors is clear. When costs go up, corporate America has no intention of letting it be shareholders who feel the pain. They argue companies are just passing higher input costs straight to consumers to protect their profit margins and earnings. They even point to the spread between core CPI and the Producer Price Index, PPI, being positive again in August as evidence.
So businesses are managing to pass on those costs.
That's their read. So ultimately, it's you, the consumer, paying more at the checkout.
It's interesting how they keep coming back to the real picture versus the official one. They even question the government data itself, saying it's like a used car salesman on April Fool's Day. That's quite the statement.
It is strong, yeah. They dig into why they're skeptical, focusing on how the CPI is calculated. They call it a product of an underfunded agency doing a tough job. But the key point they raise, and it's worth thinking about, is imputation. They say about a third of the prices in the CPI are effectively guesses dressed up in statistical glitter.
Guesses. How so?
Well, take housing. If a rental unit's vacant, they estimate its rent based on similar occupied units nearby. If it's vacant long-term, they might just copy the average. Same for other goods. If a price is missing, they fill it in based on similar items. The newsletter claims that over half the U.S. CPI, especially because shelter is such a big part, relies on these kinds of imaginative imputations.
Wow.
Over half, that's their claim. So it does make you wonder, how much weight to put on that single headline number if so much estimation is involved.
Okay, that's a big critique of the data. So if the official numbers might be missing something fundamental, what is the real driver, according to the Macro Butler? Is this where flation comes in?
Exactly. This is their central thesis. They say, forget the hype about AI deflation, brace yourself for the next blockbuster, flation. Their argument is really basic, almost economics 101. The economy is just energy in fancy disguise. They believe all our modern prosperity wasn't just thought up. It was fundamentally enabled by accessing and using high-quality energy. It was mined, burned, and boiled into existence.
So energy is the foundation, not just a component.
Precisely. They invoke thermodynamics. Energy quality matters and decays. Civilization runs on energy, not just good ideas or policies. They frame wealth simply. Organized energy doing your chores. We went from wood and muscle power for centuries, then coal, ancient sunlight squashed into black gold, which fueled the Industrial Revolution. Factories, trains, everything. But now, they argued, the shift towards renewables, which they call the flaky, temperamental cousins of real energy, like wind and solar, has consequences.
What kind of consequences?
Well, in their view, it leads to higher costs, less power, shrinking freedoms, and benefits asset owners, the landlord class. It's a pretty critical take on the current energy transition's economic impact.
It really puts energy front and center, doesn't it? Not just some footnote, but the engine itself. All the GDP, the services, the tech.
Right.
It all relies on energy being transformed.
Right, and that brings up their concept of transformity, which is basically the idea that it takes energy to get energy.
EREI, energy return on energy invested.
Kind of, yeah, similar concept. You have to spend energy to explore, drill, build turbines, maintain grids, everything. If the energy you get out isn't significantly more valuable or higher quality than the energy you put in, well, they argue you're essentially burning capital. So if our main energy sources aren't high quality and reliable in this sense, they'd say civilization is just torching capital and calling it progress.
That really reframes the discussion around energy sources. So let's bring this down to earth. In today's world, increasingly electrified, energy basically means electricity. So cheap electricity equals prosperity. Is it that simple?
That's the core connection they make. And they offer a quick cost comparison for building power plants, just ballpark figures. Coal and gas are the cheap thrill. Nuclear is like a luxury condo. Very expensive upfront, maybe $6 to $9 billion for a gigawatt. But then fuel is relatively cheap.
And renewables.
Solar and wind are the trendy options. Cheaper upfront, maybe $1 to $1.5 billion per gigawatt. But, and this is key, they need backup, often expensive batteries, because they're intermittent. Hydropower is good value but limited geographically. Their takeaway is pretty blunt. Every energy source makes you pick your poison, cost, reliability, or guilt. But here's the kicker for inflation. They argue the real threat, maybe more than oil prices right now, to both average folks' budgets and company profits is electricity inflation. Look at the numbers they cite. From 2010 to 2019, the electricity part of the CPI went up less than 12%. Okay, manageable. But since 2019, it's skyrocketed nearly 42%.
42%. Wow, okay, that's huge. What's driving that massive jump, according to the newsletter?
They point to a few major things stacking up. First, AI data centers. These things are gobbling up electricity like a teenager with free snacks.
Huh, good analogy.
Seriously, one data center can use as much power as 80,000 homes. And projections, we might need the equivalent power of 30 new nuclear reactors just for AI by 2030. That's a colossal new demand hitting the grid.
30 nuclear reactors worth?
Okay, second driver, extreme weather. They specifically mentioned the record-breaking July 2025 heat waves. Obviously a typo in the original newsletter, likely meaning a recent year. But the point is, heat waves drive up air conditioning use, hitting peak demand. Utilities then have to buy power on the expensive spot market, and guess who pays?
We do, the consumers.
Yep, passed right through. Third, our aging electrical grid. It's old. Like 70% of transmission lines are over 25 years old. That means more maintenance, more power loss just in transmission, more inefficiencies. Upgrades are slow and expensive. And then you add new strains like EVs and AI onto this already creaky system. It struggles. And finally, they point fingers at certain energy policies, what they call green energy policies. They focus on the mid-Atlantic region, calling it a power bill apocalypse zone.
Right.
Now remember, this is their perspective, but they argue that shutting down coal and nuclear plants too quickly in favor of intermittent renewables like solar and wind has created instability and higher costs. They mentioned New Jersey facing huge rate hikes like 17–20%.
So reliability issues driving up costs.
That's their argument. They highlight the PJM grid, which serves that area, as being fragile, saying 9 out of 13 grids nationally are already in a danger zone and could hit critical levels by 2030. That Baltimore substation issue they mentioned was just a reminder, they say, of how delicate things can get.
So it's this combination, massive new demand from AI, an old grid struggling, weather events, plus these policy impacts, all pushing electricity costs way up. And that feeds into everything, right? Pricier groceries because transport and refrigeration cost more, businesses facing higher overhead. It's like the whole economic engine is wheezing a bit.
That's exactly the picture they paint. They even draw a correlation between the U.S. electricity CPI and something they call the chaos index, their term for policy issues and global tensions. They say these two trends are dancing in perfect sync. They criticize what they see as underinvestment in crucial infrastructure, especially the grid, maybe sacrifice for other priorities.
Okay, so it's not just groceries feeling expensive. Soaring electricity costs add another layer of pressure, which leads to what the newsletter calls the great inflation squeeze, where wages just can't keep up.
Exactly. That's the immediate pressure point. And looking forward, their outlook is framed by that Trump stagflation concept we touched on. They look at history and argue that falling public trust, mixed with political friction and maybe trade conflicts, often leads to economic trouble. They foresee tariffs, maybe trade wars, causing prices to jump while confidence drops. And they strongly warn against cutting interest rates if inflation is still high, thinking it would just pour fuel on the fire.
It's a pretty sobering outlook. So for someone listening, trying to figure out how to navigate this, what are the main investment takeaways from the Macro Butler here? What's the bottom line for protecting your finances?
The bottom line seems to be, play defense and focus on real assets. They are really down on long-term government bonds. Avoid those, they say. Instead, focus on hard assets. Gold and silver get top billing as that eternal hedge against collective stupidity. Also, quality stocks, but specifically companies with pricing power, strong balance sheets, robust business models that can handle cost pressures.
So companies that can pass costs on.
Essentially, yes. And be ready for more bumps. They explicitly say prepare for higher volatility. Their analysis of the S&P 500 to gold ratio leads them to think the U.S. might be close, maybe just 3 to 6 months away from tipping into an inflationary bust, meaning stagflation. So, strategy-wise, favor companies with low debt that generate cash. They specifically say energy over consumers, please. Keep any cash you need liquid and short-term, maybe high-quality corporate debt. And crucially, allocate a significant chunk, they suggest 25% plus, to gold, silver, and hard commodities for that anti-fragile vibe, as they put it. Be resilient.
And the bigger picture.
They see sovereign debt crises potentially brewing. Japan, Europe, and eventually maybe even the U.S. are on their watch list.
Wow. It definitely paints a stark picture. Energy not just as a cost, but as this fundamental economic driver shaping everything. So let's wrap up our deep dive into the Macro Butler's Wattflation. Key takeaways. August CPI showed inflation is still sticky in their view. Energy is the economy's hidden engine, and those soaring electricity costs from AI, the old grid, weather, policy shifts are a huge part of this great inflation squeeze. They argue the deflation fairy tale is just that, fiction, and we might be heading into a period they call Trump stagflation, What does this all mean for you? Well, hopefully it gives you some context for why your bills might be rising, both at the grocery store and for your power, and maybe some things to think about for your financial future in this kind of energy-driven economic shift. And here's a final thought to leave you with. As our world gets more and more electrified, what hidden energy costs are baked into everything you buy and use? And how might those costs reshape the economy and your own wallet in the years ahead?